Hey guys, so today we're going to be talking about why should you get a loan? What are the benefits of getting a loan and why might you need a loan? Getting a mortgage sounds like it's super crazy, a super scary, crazy step for everybody. And rightfully so, if it's not done right. When somebody buys a house, it's very common to see a case where somebody thinks that they can qualify, or they think they know what they're qualified for, or they know what their monthly payment budget should be. And a lot of times there's a big discrepancy between the amount you qualify for and how much you want to budget for that monthly mortgage payment, and whether it includes the PITI payment, if it's just P&I, which is principal and interest, taxes, and insurance. We got to put everything together and make sure you have a realistic idea of how much your monthly mortgage payment is actually going to be. So one of the things that I always like to do is I always like to ask my clients how much they'd like their monthly payment to be. One of the reasons I do this is because it kind of gives me an idea of how realistic they're going to be when they're making their payment, or when I'm talking to them about it. If they've even looked at doing a budget, if they know what they want their payment to be. A lot of times people come to me, my clients come to me and they say, we just want to know how much we're pre-approved for. But I like to take it a step further and specifically ask them, well, how much have you and your partner, how much have you thought about actually budgeting towards the monthly mortgage payment, and what are you going to be comfortable with? The reason I do this is because it's not just about what I can qualify you for, but also what you're going to be comfortable with and what you are interested in. If you're somewhat conservative, you may not want to spend all the money that you're pre-approved up to. You may want to go a little more conservative, so I can back into the payments that way for you as well. We want to make sure we're getting pre-approved as early as possible so that we can do our mortgage planning. If we have any credit issues, if we need to save some money, it's really good to do all of that up front. So don't be bashful about getting pre-approved. Get it done as soon as possible so you know exactly what you're working with. We can put a plan in place to help you get on the right path and help you and your family continue to move forward. One of the common misconceptions is that we actually need to have 20% down for your down payment. We've got all different kinds of programs available for you, with no money down, with VA loans, no money down, with down payment assistance programs. But here's the key caveat. In order to avoid mortgage insurance, you will definitely want to put at least 20% down. Now, if you don't put 20% down, let's say you just put 10% down, there's the possibility that you could do a first and a second loan, but that second mortgage is going to be the payment that you would otherwise likely have on the mortgage insurance anyway. You'll want to make sure that you get the lowest loan amount that you can possibly get to save as much money as possible. Put as much down as you can, but you don't have to put all of the money down. You don't have to put 20% down in order to qualify. So the more money you put down, 10, 20, 15%, you guys can get your mortgage payments lower by financing less or by avoiding mortgage insurance. You could put a little bit more money down. The mortgage insurance rates will change a little bit based on how much you put down and based on your credit. But I'm going to talk more about mortgage insurance on another video, okay? The next point is the mortgage interest deduction. The mortgage interest deduction is another interesting thing that you'll want to take a look at, as it's one of the pros of owning real estate and buying a new home, because you can actually write off the mortgage insurance on your primary residence up to $750,000 on that mortgage balance. Anything of a mortgage balance more than $750,000 may not be tax deductible, but it's a phenomenal opportunity to get a write-off for your mortgage interest, which you would otherwise not be able to take if you're renting. So take the mortgage interest deduction, you get the mortgage interest deduction, and it can decrease the amount of tax liability that you're required to pay. And one of the benefits of having a mortgage and buying real estate. One of the other reasons why I recommend purchasing real estate is because you have the opportunity to build equity. Once you purchase the home, your mortgage is fixed. The homeowner's insurance can vary maybe a little bit year over year, just depending on inflation and the policy coverage. Your taxes might change over a long period of time, but they're not going to change that much. So as the market increases or decreases, your equity value will change, and it's the opportunity to build equity, save money by paying down the mortgage, and then you have the property free and clear over a long period of time or whatever you're able to do to pay down the payments. But building equity is a huge opportunity so that when you go to sell the property, you have more of a down payment on the next property, so that's a really good option. Or you're able to leverage your equity down the line to either consolidate debt or do home improvements. Building equity is a huge positive and one of the big pros of buying real estate today. Our equity position completely depends on the market as well, right? So if you're getting 100% financing, if you're gonna live in the property for a long time, it's probably okay that you don't have a lot of equity because you can write it out as long as you have a stable fixed monthly payment. So our equity position doesn't really matter until we go to sell the place. Your equity is all paper equity, and it doesn't matter really until you're looking to sell or refinance the property or make a transition. So in order to improve your equity, you're going to try to reduce the loan balance. You're going to work on improving your property. You're going to do improvements to the property that add value to the property. One other quick tip is if you make those bi-monthly payments, there's a lot of talk about the fact that you can take a 30-year mortgage and pay it down to 23 years. So that's a really good option for lowering the amount of interest you're going to be paying over the life of the loan, but also by making those double payments, you're reducing the balance on the mortgage 2 weeks earlier than you would if you're making those double payments, and that's what's actually allowing you to save money and pay down the mortgage a little bit faster. You can also make an additional principal payment every month. You can make an additional payment at the end of the year, but it all depends on what your plan is to either get the debt paid off, minimize your cash flow, or maximize the amount you're putting towards it so that you can be debt-free in the future. You'll want to be consistent with your monthly payments as well. Consistency is key. You're going to want to make sure that you're making your monthly payments on time to build good credit history. You're also going to want to make sure that if you are trying to accelerate the payoff, that you're making those additional payments every 2 weeks with more frequency so that you can get everything done as soon as possible. The more you put down towards the loan balance, the more your equity is going to be. So it's a phenomenal opportunity. People have mixed feelings about mortgages, and some think that it's like you are forced to save money every month. But what many don't see is that you're building such a valuable asset for you and your family with a home. The asset isn't cash in a savings account, it's actually equity in your home. So one point on what we're talking about with this is that most people think that the equity that they have in their home, that they have 100% access to it. So with that, I would say typically, you're going to want to keep 10 to 20% of equity in your home because that's what we can lend on, up to 80% or 90% of the value, depending on occupancy and some other things. But again, you're not going to have 100% access to all of your equity unless you sell the house. Even when you're selling the property, you're going to have some expenses. You're going to have some commissions that you need to pay. Those can range anywhere from 3 to 6%. You're going to have some closing costs that you need to pay, escrow and title fees as well. So you might have, 90% access to your money when you have your equity. Just keep that in mind. I want you guys to be informed on all the information regarding loans. Please like, comment, subscribe below if you found this information to be useful. I really enjoy what I do. I love helping families purchase and refinance their homes. And please ask me any questions you guys have. I'm here to be a resource and a tool for you and your buyers if you're an agent, or you as a consumer if you're trying to get a new loan or start some planning. Thanks for tuning in. This has been another Monday Mortgage Madness episode with me, Sean LaRue. Make it a great day.